September, all but guaranteed, with the major averages on the cusp of confirming a sharp monthly decline. That may be all the reason why our next guest needs to stay defensively positioned. Chris Toomey, he runs one of the highest rated private wealth advisory teams in the country, joins us once again right now. It's good to see you. I mean, you've been largely defensively positioned for many, many months. I want your reaction to what David Tepper told me, Chris. It's not that complicated. You're just not in QE times anymore. You're in the QT era, higher rate environment. Can't be the same multiple as before. Not bad. It's just a different environment. What do you do with that?
No, I mean, it sounds familiar. We have been concerned specifically around the fall-off effects with regards to QE being removed and moving into QT. And we have also been concerned not only just about the pace of rate hikes, but also the duration of rate hikes. And so it seems like the market has moved away from the transformational powers of AI and the hope that rates were going to come down, and really focused in on what really is the side effects of rates moving so dramatically higher. And to David Tepper's point, not having QE and now being focused in on QT.
What's the right multiple for stocks, Chris?
I mean, it's twofold, right? If rates are here or potentially going higher, you'd have to expect multiples would have to start to come down a little bit. I think the bigger issue is going to be around earnings, right? So we've seen a situation where going into the year, we, like many of the others on Wall Street, were expecting GDP to be suboptimal and earnings to be down. And instead, we saw a real situation where the consumer stepped in. They had $2.2 trillion worth of savings, which they aptly put to work. We saw the federal deficit blow out 7.5%. And importantly, which people are starting to focus in on, especially because it's up over 30% this quarter, gasoline prices went from $5 down to $3, right? And so those are kind of one-off type situations. And I could make the argument we're actually in reverse right now, with oil going back towards $100. And the consumer, instead of sitting on $2.2 trillion worth of savings, actually looking at a situation where credit card debt is over $1 trillion, and that debt payment is over 20%. So in addition to QT pulling liquidity out of the market, you also have credit card debt pulling money out of consumers' pockets.
So the flip side, I guess, is I hear you. I mean, those are all the risks that everybody who is negative or cautious the market would suggest you need to be keeping an eye on. But what about the idea of this fourth quarter chase? You know, money managers who just missed it from the beginning of the year. You know, they were mispositioned, as some have suggested, and that's going to result in a dash to the finish from those who want to get, at least while they think the getting can be kind of good. Who knows what happens next year with earnings? Do you put anything into that?
Look, I mean, that is a part of, the Wall Street kind of seasonality, right? Whether it's September being bad, or window dressing at the end of the quarter, or managers chasing at the end of the year. But I mean, let's dive into the numbers, right? So the market right now, S&P 500 up about 12%. You strip out the Magnificent Seven, it's up about 2 or 3%. You look at an area like healthcare, fairly defensive area, over 2/3 of those stocks are actually negative this year, right? So this is the weakest, quote unquote, bull market in the last 60 years. And this is a situation where the majority of stocks in the S&P 500 are actually below their 200 moving day average, and 25% of the stocks are actually negative. So there's a little bit of deception with regards to what's going on in the market. So if you're a money manager and you're trying to chase this market higher, I think you have to be really concerned about how you chase it, right? Are you going to go back into these higher multiple stocks that are actually starting to sell off pretty dramatically? Or are you going to start looking for opportunities in names that have been beaten up? But my thinking would be that the economy and some of these other areas are just going to weigh on the overall market. And to David Tepper's point, it might make sense to be more cautious sitting in 6-month CDs that are paying you 6%.
But see, this so-called deception that you mentioned works both ways, depending on which way you want to frame your argument. Now, people who are, more cautious would say, well, the multiple on the market's too expensive. Look at it's trading 19 times. There's no way the market's worth 19 times. Is it really 19 times? It really isn't, because if you strip out the 7 stocks that we've talked about, the equal weight S&P, that's not trading at 19 times. It's obviously much cheaper. So it skews both ways depending on how you want to look at it.
That's right. And so I think your question is, what's going to drive this market higher? Is it going to be specifically money managers chasing and bidding up these stocks and pushing these index higher with those higher multiple stocks that are a bigger part of the index? Are they going to be looking at individual stocks in the underlying index that might not have as much to do with the index? Or do you look at a situation where you start playing defense because of all of the concerns we talked about? I think one of the things that people haven't focused in on, if you look at the fixed income market, right, we have a situation where the aggregate bond index is actually now negative. Bonds are down about 3% for the year. And you look across bonds right now, you're in a situation where the only thing that is actually positive are short-term rates. And if you look at corporates, September is typically a very busy month for corporates with regards to issuance. And this has actually been a very quiet month, which has actually helped corporate indices do pretty well. The flip side to that is if corporations aren't issuing debt because the cost of capital is so much higher, one of the other drivers for this market has been buybacks, right? And it was a lot easier to buy back stock when you could issue debt at really low prices and then go buy back stock. This is a different situation now because of what's going on in the bond market.